Hello students, this is chapter 8 application the cost of taxation, in which the first topic is the Deadweight loss of taxation. Its introduction part has been covered up with my last video. In this video we will start with its sub part, that is how a tax affects market participants. Let's start. Let's use the tools of welfare economics to measure the gains and losses from a tax on a good. To do this, we must take into account how the tax affects buyers, sellers, and the government. The benefit received by buyers in a market is measured by consumer surplus. And what is consumer surplus? It is the amount that buyers are willing to pay for the good minus the amount they actually pay for it. That is the consumer surplus. The benefit received by sellers in a market is measured by producer surplus. What is producer surplus? It is the amount that sellers receive for the good minus their cost. Now, what about the third interested party? That is the government. If T is the size of the tax and Q is the quantity of the goods sold, then the government gets total tax revenue of T times Q. It can use this tax revenue to provide services such as roads, police, and public education, or to help the needy. Therefore, to analyze how taxes affect economic well-being, we use the government's tax revenue to measure the public benefit from the tax. Keep in mind, however, that this benefit actually accrues not to the government but to those on whom the revenue is spent. So, as you can see in this figure, this is the size of the tax, okay, which is represented by T, and this is the quantity of the good sold, represented by Q. As you can see, this is quantity with tax, okay. So this is quantity sold Q, height times its width, that is T times Q, is will be equal to this area, to this shaded part, and this will be the tax revenue. So this rectangle, which is the shaded part, as you can see, this is the tax revenue T times Q. Thank you.